We're looking today at Ares Capital. This is a BDC that pays a forward yield of 9.24%. We have a triple buy rating. In fact, we have a strong buy from Quant. And when we do take a look at just some high-level grades, an A on valuation, a B- on growth, a B+ on profitability, and in fact when we take a look at insider buying, we note over 7 million over the last 3 years. So is this an incredible company that we need to consider for our portfolios? We're going to do an in-depth dive as always of this company. We're going to look at their top line revenue growth year on year, as well as their bottom line net income. We're also going to look at the health of this company, their total cash versus their total debt. We'll also discuss a little bit about that insider buying versus insider selling, as well as looking to both institutional buys and sells to understand what they are preferring with this BDC. We'll also take a look at their dividend safety, very important for a company that has a yield of over 9%, as well as the underlying metrics, the free cash flows. And we'll also talk about their latest Q1 presentation of 2024 to understand where this company is moving over the next few months. And as always, we will run them through our own valuation model to get to both our intrinsic value as well as our acceptable buy price, given our margin of safety, as well as looking to Wall Street to see what they're forecasting for the price over the next 12 months. So let's start off with a historical performance of this BDC, and what we note over the last year, a strong performance up nearly 15%. When we zoom out over the last 10 years, they are up only 25%, although do bear in mind that this doesn't include those dividends reinvested, so if we were to include that, it would be slightly higher. Nonetheless, not the greatest over the longer term. When we take a look, it does trade towards its 52-week highs, and as we mentioned at the beginning, a triple buy rating, a forward yield of over 9%, 9.24 to be exact, and a forward P sitting just below 9, 8.88. So let's take a look and understand whether or not this is a strong company for us to add with a very high yield. Now, in terms of top line revenue growth, what we do want to see is around 3 to 7% growth year on year. What we in fact note, it has more than doubled over the last 10 years, 989 million in December 2014, and we can see their latest annual report, 2.61 billion. And when we take a look on a graphical basis, some very strong performance year on year. We are seeing that growth, so that is the first sign that we always like to see when we do analyze companies. The second part that we do take a look at is their bottom line growth, net income year on year. We do note this is a little bit more inconsistent, just under 600 million in December 2014. Latest annual report of 1.5 billion. So yes, over the longer term, we do actually see some very nice growth, but on a year-to-year basis, we do see a lot more inconsistencies. Nonetheless, over the long term, it does tick those boxes. When we take a look then at the health of this company, their total cash versus their total debt, what we do note is 195 million sitting on the balance sheet in December 2014, 510 million from their latest quarterly report. So in fact, over the longer term, their cash position is building higher and higher. Some inconsistencies, although we do note. We then compare this numerically and directionally to their total debt, but we also note for BDCs, they will have a fair amount sitting on their balance sheet. 3.9 billion in 2014, and we see their latest quarterly report just under 12 billion. So an increase of around 3 times, but again, to be expected. And as we can see here, over the longer term, it has been increasing. Now, something we will factor in when we do look at that dividend safety is that will be very important for some of these metrics moving forwards. Now we can take a look at their earnings estimates, how they've performed and future expectations. First thing that we do note, over the last 4 quarters, they have beaten the expectations, so 75% track record, although we do note in the more recent quarter, Q1 2024, they did miss, although marginally. Moving forwards though, for 2024 and Q1 of 2025, something just to bear in mind, they are expecting a year-on-year decrease to the earnings per share by around single digits, something we need to factor into our own investor thesis as well as our margin of safety. We then take a look at the valuation grade. Very nice to note they do get a very strong A grade. Now, one of the things we do draw your attention to is the P on a non-GAAP forward basis, 8.82, as we can see here, the sector median, so others in the similar industry, coming in fairly high, 10.75, so they are in fact lower by around 18%. Now there are the metrics, as you can see, pretty decent grades, B plus A's, as well as a D depending on how you value this company, but the EV to sales isn't one that is appropriate for BDCs, and we can see others. Again, information is there if you do prefer any of these valuation methods. We then draw your attention to the growth grade. They get a B-. Now, a few of these metrics that will draw your attention. Year-on-year increase of their top line, 18.6%. When we take a look at the sector median, a lot lower at 4.08. On a forward basis, signaling double-digit growth to their top line, very positive, 11.36. Again, we can see the sector median around 4.99. And there are other metrics here if you do want to take a look. Again, as we can see on a forward basis in terms of gap, we do see growth on the earnings per share, 22.73% forward looking, with others in the industry around 2.97%. Again, as we can see here, other methods if you do want to include. We then move on to the profitability grade. They get a B+, so a few things just to signal. Their gross profit margin, 100%. Sector median, 59.62, so significantly better. On an EBIT margin, a little bit more relevant, 70.45%. Sector median around 23.28. And we do also note on a net income basis, 62.77%. We can see the sector median, 23.07, a lot lower. We then see other metrics, again, whether or not you want to include, but in terms of a conclusion for those that are relevant to this BDC, we have valuation of A, growth of B-, we get profitability of B+. Overall, it does look fairly solid. So then when we take a look at their historical performance against others in the industry, what we have here, we have Blue Owl Capital, Main Street Capital, one we have reviewed not too long ago, as well as a few others, in fact, BDCs. So over the last year, so this is total return, this means including those dividends reinvested, you would be up 26.51%, but what we actually gather from this graph, over the last year, BDCs have performed very well, as we can see right across the board. When we expand it over the last 5 years, we actually see ARCC, one of the better performing, up 91.22%. Pretty positive over a 5-year period. And when we expand that over the last 10 years, we do see again very, very strong, up 223.25%. One of the better performings, as we can see, second to Main Street Capital. Now, over the last 10 years, this is a very strong performance. Do bear in mind that past performance is not an indicator of future performance, but as we can see, historically, very strong. Now, don't forget as well, they do pay a very high yield as well, so for those that do actually not reinvest and take those dividends for their expenses, it could also be a positive option. Now, in terms of insider ownership, 0.64%. What we note is 6 instances of insider buyings over the last 5 or 3 years, in fact. And when we take a look to a comparable basis, 1 insider selling of around 515,000 with 7.31 million of investor buys. Now, to see the more recent one, we just go quarter on quarter, and we can see Q2 of 2023, $268,000 worth of buys. When we look at who those investors are, who those individuals, insiders are, what we do note here is that Michael, an insider, did buy around 15,000 shares for around $17.84, so lower than the current trading price, at around $267,000. We also do note other insiders having bought, in fact, the CFO themselves, but a few years ago. Again, whether or not you believe this is relevant, given the fact that the more recent insider buying was the 2nd of May 2023, probably something not to include. But as always, information is available and there, so full transparency. In terms of institutional ownership, we see 27.38%. We see 392 million worth of sales by the institutions over the last 12 months. Same period, we see a lot more buying, nearly double, in fact, just under 700 million. And even on a more recent quarter, so Q1 of 2024, we see a lot more buying. In fact, you have to go quite some way before you even see more selling than buying. You'd have to go all the way, as we can see here, to Q1 of 2021. So interesting to know whether or not you want to include. Always do your own due diligence. Don't copy institutions, don't copy insiders, but information, as we can see, can then be used within your own analysis. Now, before we do talk about their dividend safety, let's just jump into the first quarter presentation. Few things that we do want to point out. Now, what is quite interesting is when they did announce this and showed the slides, they have included not just the same quarter from last year, but also the previous quarter. So on a net income per share basis, we can see they've increased from the previous quarter as well as the same quarter in 2023. When we look at this metric, again, very important for BDCs, the net investment income per share, we do in fact note that it is slightly lower than the previous quarter as well as the same quarter from the previous year. And there are other metrics here if you do want to take a look, but what I do quite like about this company is their transparency in the information. We then take a look at their investment portfolio, so it shows us by asset class as well as the industry, so nice to note they are fairly well diversified. Their largest industry that they do operate in, 23% software and services, and then we have healthcare services coming in second. Always good, especially for business development companies, where we do see quite a nice range of diversification across both asset class, as we see here, and the industry. We then take a look at something I thought was interesting, their backlog and their pipeline. As we can see, a $1.3 billion backlog and a pipeline of $30 million. And again, if you want to see the breakdown between asset class and the industry. Finally, for those that do like dividends, as we can see here, they do pay a very nice dividend. On top of that, we do note in 2022, every single quarter, they did pay an additional dividend of 0.03 cents per share. Very nice to note that historically they have been increasing it as well. Now, before we take a look, just want to point out we have released our latest free weekly article. If you want to gain access to this or any other articles, all completely free, do click on the pinned comment below, instant free access. And just to draw your attention to this article here, for those people who ask what are the websites, what are the resources we use, it is all explained in here so you can copy along and do your own analysis as well. So jumping into the dividend safety, we have a score of 59. It is borderline safe, so we can touch upon this, as it is important for their dividend, which is above 9%. Market cap, 12.7 billion. It is a large cap company. Now, just to let you know, their dividend safety score was reaffirmed just a few months ago, so we do have here a suggestion of a moderate risk of a dividend over a full economic cycle. Now, last recession, how did they perform? Well, they in fact cut their dividend during the 07-09 crash, didn't maintain it, and also didn't increase it. However, they did have plus 2% recession sales, significantly above the average of the S&P, which came in at negative 12. And when we take a look at the recession return, negative 76%, with the S&P around negative 55. In terms of dividend growth, we're waiting for the latest increase to appear. Last 5 years, on average, 5%, so nice to note, above 9% yield, as well as above inflationary increase, which we do advocate on the channel, minimum of 4% year on year. And over the last 10 years, 2% per year. Not that great, but again, factoring you are getting a very high yield. We do note 3 years of consecutive increases, whilst paying a dividend for the last 13 without a reduction. Now, when we take a look at dividend yield theory, it does state a company is undervalued when the current yield sits above the 5-year average. What we note here, reasonable valuation, 9.18, not too far off 9.27. And on a forward P, we do note it is lower, 9.1 versus the 5-year rolling of 9.9, as well as being lower than the financials sector P of 11.5. Just bear in mind, we don't look at any of these models in isolation and will conclude towards the end. In terms of earnings payout, well, we would like to look at the free cash flow as we normally do on this channel, but a lot more volatile for BDCs. So what we do look here, 95% or lower. And what is nice to note, yes, it has been higher over the previous last few years from 2014 to around 2018. Since then, it has come down pretty much in the 80s, 81% in 2023, 83% in 2024 expected. So that is a good sign in terms of dividend safety. We then look at the earnings per share, and as always, we do want to see this increase year on year. It has increased, although we should point out pretty inconsistent. Some years, in fact, it has decreased, and then we are expecting 2024 to drop down to around 2.3. When we then look at it percentage-wise, for those that like to see those numbers, we do note a little bit inconsistent. Some years of strong double-digit growth, some years we see flat, and a few years, as we can see here, negative. 2024, negative 4% expected. When we look at the top line revenue, we can see double-digit growth over the last 3 years and pretty strong and consistent. As we can see here numerically, pretty much what we saw earlier, a different format. And we do note they do dilute your position over the longer term. Again, very, very normal in the industry due to the fact that they do have high payout ratios and therefore they do need to borrow money and issue shares to grow the business. So in terms of the ROIC, return on invested capital, we do like to see typically 10% or more just to give us faith that management are able to effectively allocate their capital. Above 8% for BDCs, we see it pretty much straddle around that 7 to 8% year on year, so not too bad, consistently around the levels that we do want to see. And in terms of operating margin, free cash flow margin, as well as the net debt to EBITDA, something we do typically like to look at and review on other companies. For BDCs, it isn't meaningful as the EBITDA is not a meaningful measure. The fact that this is the interest is a core component of their revenue and expenses. So let's jump into the valuation model. As always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. So the first model we're looking at today is the Graham's valuation formula. Stock ticker symbol, the earnings per share. We have the long-term growth rate, AAA corporate bond yield to give us an intrinsic value of just under $20. Now, market value around $20.92. We do have our overvaluation signal here, but given the fact it isn't too far off, you could justify reasonable valuation. But also bear in mind, we don't look at any one of these models in isolation. We then have the multiples valuation model, companies in a similar sector and size that we looked at over the last 10-year period. Their average PE, the EPS, we have the intrinsic value showing us here a significant undervaluation signal, 20.9 versus the intrinsic value of this model of 28.48. We then move on to the dividend discount model. As we can see here, average growth rate just under 5%. Now, it does look a little bit skewed as we did see special dividends incorporated, but there has been no dividend cut over the more recent period. And when we look at the growth rate forward looking, we have gone very, very conservative at 0.25. This gives an intrinsic value showing some nice undervaluation at 24.84. Now, typically the discounted cash flow model would be one that we use as our fourth and final model. Given the fact that, as we saw earlier, it isn't relevant for BDCs, we will be removing this from our final calculation. So the intrinsic value here is just the average of these three models, coming in today's episode of $24.33. Do bear in mind you can click on the pinned comment below so you can get to the valuation, the intrinsic value and acceptable buy price of companies in your own portfolio, as well as those on your watch list by clicking on the pinned comment below. So 10% is a margin of safety that we do start off with as always, and we only execute if it meets our three golden criteria: a wide moat, strong financial metrics, good forward-looking data. If you believe that for today's episode, it would be a buy up to around $21.90, and then we keep going till it's near the current trading price. And we can see in today's episode, Ares Capital, ticker symbol ARCC, has a near 15% MOS level based on our estimates and judgments, an acceptable buy around $20.68. Now, in terms of Wall Street and their expectation over the next 12 months, their price target is $22.40. They see upside of 7%, bearing in mind you are also getting a yield of over 9%. And as always, do let us know your thoughts in the comments below. Is this high yielder one that you do believe is a buy? As we saw at the beginning of the episode, we had a double buy rating as well as one strong buy rating, and when we did look at the underlying metrics and their grades, they did look to be very positive. As always, if you enjoyed today's episode, smash that like button, hit that subscribe and bell button, let us know your thoughts in the comments below, and as always, we'll see you all on the next one.